Okay, great. And it's 12:30, so we're going to get going. This is our third session of How Profitable Will My New Orchard Investment Be? I'm Liz Higgins, Extension Specialist with Eastern New York's Commercial Hort Program with Cornell University. And my project team is also Craig Kalke of the Lake Ontario Fruit Team, Dan Donahue with the Eastern New York Commercial Hort Program, and Mike Baysdow with the Eastern New York Commercial Hort Team. So if this is your first time joining me, that's great. I will be able to periodically look at the chat feature if you have questions, and I'll try to answer them as we go on, and I'll leave some time at the end. Otherwise, at the very end, if you raise your hand or if you'd like me to unmute you too to ask questions, I can do that. The webinar format doesn't really allow easy access to let everybody talk, but I can definitely unmute people. So with that, let me just share my screen and we'll move on to the presentation. And yeah. Okay. Sorry about that. One more second. I just had a quick technological glitch. Okay, and share. Great. All right, so today we're going to start to get into more of actually starting to use your financial data to make management decisions. And once again, this is the funder. So in the first webinar, if you can remember back a couple of days, we really looked at using sort of standard farm financial records to look at the whole farm financial picture. And so today we're going to really start to help you think about breaking your farm into smaller management units for analysis. I'm specifically going to cover like thinking about profits and profit centers and cost centers, and these are ways of sort of dividing up your farm business into sort of those units of analysis. I'm going to cover direct versus indirect costs and some strategies for thinking about allocating indirect costs. That's cost allocation. Variable and fixed costs and relevant range. So when, under what range would you think about a fixed cost? And although this is a lot of information that is fairly dry, I'll admit, these are the tools and these are sort of the concepts that we're going to use as we move forward into enterprise budgeting and operational budgeting, sort of, and to start doing some analysis. So I don't think that this webinar will necessarily take very long, but these are concepts that you will definitely be referring back to later. So a profit center. The profit center is the part of your farm business that generates revenue from sales and you incur costs to bring the item to market. And one of the challenges that that farms have in using their financial data to make business decisions is that a lot of times that data isn't organized in a way that's useful for making management decisions. It's organized more for like tax purposes or compliance purposes rather than management decision making. So starting to break your business and really conceptualize it into things like profit centers, cost centers, and things like that can help you then, sort of create these units of analysis that when you're starting to think about making an investment, you're looking at the specific part of the business that you want to analyze, and you're also able to really start to get a handle on how that part of the business contributes to overall profitability of the entire business. So the profit center is that part of the farm business that generates revenue from sales and you incur costs. And in the key concept behind a profit center is it's the part of the business where your goal is to make a profit. It's an enterprise is also another term that people talk about, when you're talking about a profit center. It has two parts, the revenue from sales, and then it has associated production costs. So those are all those expenses that you have to actually bring whatever it is you're selling to the point of sale, either through, producing the item, like producing an apple, or for purchasing an item and reselling it. So if you have a farm stand and you buy goods from somebody else and you resell them, that those acquisition costs and all of the costs you have to then sell that item would be the costs associated with your farm stand, profit center. And one key thing about a profit center is that you determine as a manager how you want to break your farm. There is no one right way to do this. A lot of it will depend on what you want to analyze and the level of detail that you want to go into as far as really sort of dialing in on your the profitability of specific pieces of your farm. So Bob's Orchard, like the entire orchard enterprise can be a profit center, right? Like, even if it has multiple different things going on, because you have the whatever the orchard products that you sell, and then you have all of those costs to bring the orchard products to sales. That would be very simple, relatively simple. You could then break that orchard down into, like, if he's got a fruit production and a farm market, could be the two profit centers. You could break it down further into apple production, blueberry production, and a farm market. You could break it down, depending on this business, to club apple production, pick your own apple production, blueberry production, and a farm market. And as you can see, like, the more profit centers you identify, the more you could really start to then to compare your blueberry production profitability compared to your club apple production profitability as far as how they contribute to overall farm profitability. On the other hand, as you get more and more specific like this, the amount of sort of record keeping and data analysis becomes more complex. So you also have to determine what you really need to know. So for example, if club apple production and pick your own apple production, if they really aren't that different from each other, you might not want to break them down into two separate profit centers for the purpose of analysis. Especially if you're really just comparing apple production writ large and you're really concerned about blueberry production and you really want to analyze that. Or you might want to just, but for some farms, maybe it's just fruit, you really just care about like the orchard part versus the market part, right? Like, so I just want to say, like, these are, to a certain extent, these are management determined decisions about how you decide to analyze your farm, your farm management records. A cost, I guess. So I just want to say, with a profit center, when you're thinking, then once you've determined what this is, one thing about a profit center is for increasing your overall profitability, you have three strategies, right? Well, two overall strategies. You can either increase revenue, right, or you can reduce costs. Whereas, and then under increasing revenue, you can either get higher prices or you can sell more units. Those are your strategies. And so a lot of times your investments around a profit center are either going to be cost reduction or revenue increasing, right? So those are the things that you'll be looking at in there. So as I touched on earlier, when you define your profit center, the more you break it down, the more, the more work it is, the more, so there's more complexity of the data analysis. And so you always want to be balancing the value of that data, the value of that information, with the cost of acquiring that data. So by defining your profit centers and assigning costs to these centers, you can really, you can determine the contribution of that investment to profitability. But, you also, can spend a lot more time sort of in record keeping. There's more challenges with errors in record keeping. So it's just something to balance. So, and costs can be, tricky to, to allocate at times, because often costs are shared among different enterprises. But one of the goals of defining these profit centers is to be able to calculate the gross profit or gross profit margin for each enterprise and see how that then contributes or compares to overall farm profitability, and help you determine maybe which enterprises seem to be lagging, which ones seem to be doing really well, and you see, like, if there are areas that you might want to either divest from or invest more in. So cost centers are activities that support the profit center. but they don't contribute directly to bringing in revenue. Another term for this that we tend to talk about this is overhead. Investments in cost centers generally have a purpose of reducing costs, either financial or human costs. So it's either going to save you time or risk, or it could be actually saving you money by improving things. And these investments often improve the overall financial situation of a business, or they make the business more sustainable or efficient. And these are things, when we talked about value chains yesterday, these are those things in green. It's research and development, human resources, management, operations, marketing and sales. And once again, these are not, your farm, you may just want to lump it all into overhead. Or you may want to break out, HR and management. You may want to have track sales separately and really, evaluate how you're doing there. So those are also, how you break those out is management determined. But these are really looking at your overall sort of operational efficiency. And they are also very important to consider. So for increasing your overall business profit, the only way a cost center is going to contribute to profit is essentially by reducing the costs of that cost center. But when we say reducing costs, we're talking about increasing either the efficiency so that you get more work out of or more benefit out of the costs that you pay for that overhead. So if you upgrade your finance software such that, there's fewer errors and it takes less time to do transactions, that would be more efficient. And so that would be, even if it costs you more to have that software, it could reduce costs overall, in the long term. You could be reducing overhead costs. Maybe you have really high utility costs, sort of overall, or you have too much, sort of old infrastructure, sort of writ large, not, specifically that you're using for a profit center, but just kind of the you just have some overhead that you're not utilizing and you want to reduce that. Or you want to increase its contribution to the success of a profit center. So investments in marketing and sales, for example, could make, it may help you actually contribute to helping you sell more apples or helping you attract more people to your pick your own. So that's really, those are really the goals for increasing, improving a profit center. So the next thing I want to talk about is sort of when you're doing these profit centers or cost centers, one of the biggest challenges and what sort of, I think, keeps people from really, tracking this type of data often is the challenges around allocating costs and assigning costs. So we have a couple of different kind of costs. We have direct costs, and those are those costs or expenses that you can directly assign to a profit center or a cost center in a very cost-effective way. And when I say that, so if the employees on your farm that you hire to harvest only harvest apples, then all of their wages are easy to assign as a direct cost to apple production. So you're directly saying all of these costs go to apple production. And I'm putting them all there. And so as you can kind of see, I think, is the broader your profit centers in cost center definition is, more of your costs are direct costs. So if you just say my profit center is my farm, then all of the costs are directly associated with farm production. You don't have to allocate anything. If you divide things out, if you've got production, tree fruit production, and a farm market, those things, it's easier to allocate expenses when it's used specifically for one profit center or one cost center. So the wages for staff that only work in the farm market, it's easy to direct cost those all to the farm market, and the wages for the staff that only work in the field, would all go for production. So that's the idea of a direct cost, is it's those costs that are specific to a specific cost center, and the key really is cost effective. And I'll touch more on that in a second. The other kind of costs are what we call indirect costs, and those are costs or expenses that can't be directly assigned to a specific profit center or a specific cost center or a specific enterprise in a way that's cost effective. I mean, theoretically, every single time any receipt came in, you could sit there and, like, let's just say there's 35 different little items there. You could, allocate every single one theoretically to a specific cost directly. But a lot of times the time management to do that and the cost to do that in labor and sort of, effort isn't really worth it. Or it's just, it can be really challenging. So an example would be, so if all the employees you hired for harvest labor hire apples, and you have 15 variety of apples that they harvest, then their wages might not be really easy to assign as a direct cost to, like, Fuji production. You're going to probably end up doing some cost allocation. So you're going to say, okay, I've got all this harvest labor data, and I'm going to assign out of that pool of that data, I'm going to assign an indirect cost to the center. So I might say 15% of harvest wages I'm going to allocate to Fuji, 30% are to Gala production. So you don't know exactly what it is, and so you're coming up with an allocation strategy. And those strategies can vary depending on how much, if the more information you have about how those costs should be allocated, the more accurate that cost allocation will be of indirect. In some cases, you're just sort of making a guess, and maybe it's just 10% to everything, right? Like, you really don't know, so you're going to spread it out. The key concept with indirect costs and cost allocation is, the more you just sort of spread it out, the more that you could be overestimating what the costs are to one enterprise and underestimating what the costs are to another enterprise. And that, so such that your profit information about that enterprise could be off. So the more you can direct cost things, the more accurate your information is about how profitable that part of your farm is. The more you're allocating indirect costs, because you can't specifically assign a cost to a specific enterprise, the less accurate your profitability data will be. You may be overestimating profitability in some areas and underestimating profitability in other areas. But sometimes, that overall difference, it's worth it, because the effort to get that data could be too much effort, really, for you. The value of the information isn't good enough. So one of the rules of thumb for allocation is, the smaller the amount of the expense, the less economically it is worthwhile to trace it to a direct cost, to a specific profit center. So as an example, if one of your apple harvest workers also, like, 1 week worked for 2 hours harvesting blueberries because you needed the help, it really is probably not worth pulling that cost out of the harvest apple expenses and reallocating it to blueberries, because in the grand scheme of things, it just doesn't change the overall costs that much. So there is, so for small amounts, unfrequent amounts, it's easier to just sort of, allocate the costs to where most of the costs go. You also want to consider what available information you have for technology. So in some cases, you may have barcodes or scanners or digital time records where, that allocation is automated, and it's quite easy for you to allocate costs and expenses. But what's viable for one farm might not be viable for another farm. So the rule of thumb is really, once again, thinking about the value of information compared to the effort for information. Another technique that some people do is to take a sample of data and then use that as the basis for allocation costs going forward. This is very common. So, if you want to allocate your labor among several different enterprises, you might really just go out there and really track labor allocation during a harvest season for a couple of weeks, and then use those percentage times to allocate wages among varieties going forward. So if you think there's a big difference in pruning, this type of, system compared to this other type of system, and you want to be able to, like, look at the profitability of two different systems, you might want to just sort of, like, quickly, spend watch people do it for a little while to get a sense on like the difference in the time, and then just allocate based on that data that you collected going forward. So rather than tracking every single day what people do. So this is where, as a business owner, you will make decisions based on your analysis needs and level need for specificity, and then also your available resources that you can actually do that work. There is no one, only one way to skin that cat. The next thing I just want to cover then will be variable versus fixed costs. I think a lot of you probably have a handle on this, but just to make sure, variable costs are costs that change in proportion to the changes in the relative level of an activity or volume of output. And the key concept with this is over a specific period of time. So there is always a time element to a variable cost and turning into a fixed and fixed costs. So example of variable costs, in production would be, you purchase more bins if you have more apples. You use more fuel if you make more deliveries. You use more chemicals if you have more trees or if you have more pests. So in each case, these are variable costs. They go up, they go down, depending on, your level of effort. But you can also see, like, the bins are a good example of something that, it's variable. Maybe, your number of bins may change over the season based on your production, but also, if you've purchased a certain number of bins, you have those bins, even if you have less production, right? So it becomes a fixed cost at that point. So, there's, up to a certain point, then after a certain amount of time, you'll either sell some bins or buy some more bins or have more apples. So, so there's always this time sort of understanding of variable costs. But in general, they're costs that change proportionately to production. Fixed costs, on the other hand, remain unchanged for a specific period of time, despite wide changes in the related level of activity. So fixed costs, the other key thing with fixed costs, and this is sort of from a profitability standpoint, is they become smaller on a per unit basis as the number of units produced increases. So when you have fixed costs, so like, for example, if bins, my example of bins back there being a variable cost, it could be that if you buy like a certain number of bins, you want to, that could be considered a fixed cost. Like you've made that investment up front. If you only fill like a tenth of them, right, that fixed cost was going to be more per unit of apples as compared to if you use all of the bins. So if you purchase a harvest platform, and I do everything in I don't know if it's really $10,000. I often use $10,000 because the math is easy for me to do. If you purchase a harvest platform for $10,000, if you use it to harvest 10,000 apples, it's $1 an apple, right? But if you use it to harvest 100,000 apples, it's 10 cents an apple. And for 1,000,000 apples, it's a penny an apple. So you can see that fixed cost, anything that is a fixed cost in your budget, you want to, utilize it more and more and more towards its capacity, rather than, less capacity. The more capacity you can use that fixed cost for, the less per unit it's a cost to your overall, on your overall budget. And that's where relevant range comes into play. The relevant range is that normal activity where there's a relationship between the level of activity and a cost. And so, if we think about a machine to install and remove hail net, if it's $10,000 and it's recommended to have one machine per 100 acres, that relevant range for that fixed cost is between 1 and 100 acres. So if you're, so that is, that's where there's, that relationship. Once you get to, for 90 acres, it's going to be $111 per acre. But if you get it to 115, now you've jumped up. You may theoretically need to buy 2 machines, right? So you're even though you don't have much difference in acres, you have a significant difference in the cost per acre because you've moved beyond that relevant range that $10,000 cost is in. It also can change rates at different levels of effort. So utilities can change like during different times of the day. One that we see a lot is labor. at 60 hours, under, below where we have to pay overtime, the relevant range for a $20 an hour estimation of labor costs would be, from 1 to 60 hours. If you're more than 60 hours, though, it's now time and a half. It's $30 an hour. So that relevant range for a $30 hour wage is anything over 60 hours. And so when we're creating our budgets and we're thinking about that, when we have these estimations, it's only that price is only really relevant within the range that it's accurate for. And this can be important to think about, I think, especially because when you're really thinking about equipment that has, a break point or a point at which like you need to make a decision about, and like this, does this, after a certain point, that system might not work anymore that you have because, that level of equipment that I'm assuming, no longer is relevant for that. And actually, I guess as I was, and you see this often in operations. I was thinking specifically around dairy farms. A lot of times, you have to have a certain level of infrastructure. Maybe you need like a CAFO system, and it's good for up to 200 cows. That adding those additional units after that now is like is a whole nother. You need to either expand the system greatly, or you need to do a whole different system, but you're not going to maintain that system anymore once it becomes, because adding a couple more units might mean that you're now adding like a much larger fixed cost onto that. So that's why relevant range is really important, is because it helps you figure out like under what range are my assumptions about profitability, especially with these fixed costs or levels of effort. Are they still relevant, or where might I need to like have a different sort of assumption of profitability? And with labor, it could be like, there's a big difference between under 60-hour labor and over 60-hour labor. With equipment, it could be there's a big difference between, like what I can do with this equipment and when I need to jump up to a different piece of equipment. So that's pretty much what today's topic is. I'm trying to break this down into chunks so it doesn't get too tedious. Tomorrow, then, we're going to really, start talking about developing and using operating budgets for analysis. And that's where we're going to sort of put in a lot of these concepts and talk about, okay, so we've talked about cost allocation. Let's see how cost allocation could work in an operating budget. Let's see how relevant range could work in developing an operating budget. So I guess, are there any questions about any of the concepts that we had today? So if not, then I will see hopefully some of you all tomorrow where we do operating budgets. And then after that, we're going to break operating budgets down to enterprise budgets for analysis. So that's what we have coming tomorrow and the next day, just so you can anticipate what we're going to do next. And just to remind you all that all of these recordings and information will be available online later on. That's also, I'm trying to keep these relatively short so that they're easier to refer back to later if you are trying to do work later on. So with that, I guess I will say good afternoon, and we'll see you tomorrow.